Hello again everyone, here Chris Capri, founder of Second Skies. Today we're going to be talking about one of the more popular indicators out there, which is the MACD, or Moving Average Convergence Divergence. It's founded by Jerry Appel. I've already familiarized you with the acronym there. What it's doing is it's using moving averages which are converted into a momentum oscillator. It's basically calculating the difference between two moving averages, a shorter and a longer period one. And it's also a centered oscillator, which means that it has a center line or an equator or a line down the middle for price action and momentum, generally signifying whether we're in bullish or bearish territory. The basic setups for it is a 12, 26, and 9 period for it in terms of your inputs, and it's really, as I mentioned, measuring the difference between the two moving averages. The main thing to note between the two moving averages, the 12 and 26, is that if there's a gap between the two lines, if it's increasing or the two lines are separating, for that to happen between the two moving averages, you have to have an increase in either buying or selling to change those moving averages, particularly the shorter term one, which is going to be more sensitive to price action. If it's a gap and a crossover to the downside, that means an increase in selling. We'll show you in just a moment here now, but some of the basic strategies are, we're looking for an upward crossover of the two lines. We're looking for the shorter moving average to cross from underneath to the upside of the longer moving average, and when that starts to increase the gap between the two, that means bullish momentum is increasing. The inverse is true for the downside. So when we have a crossover to the downside from the shorter moving average to the longer, if it crosses over and the gap is increasing, then that generally means there's bearish momentum is increasing as well. Let's take a look at this here. So this green line is the shorter moving average. We have a nice little crossover here, and it starts to gain some distance and separate from that longer moving average, suggesting that buying pressure is on. And as we can see, this is followed up by a very large move in the pair. This is almost 600 pips. And so with that separation and then the crossing of the zero line, generally is a good indication that we want to be long this pair. Now when we see this type of situation, it means that there's really no favorable increase between the momentum to the upside or the downside, and since we're already in an uptrend, this generally signals some sort of continuation. Maybe not total strength, but that a continuation of the trend in the particular direction. Here's another example of it here. So we have the crossover first before the price falls. This is about a week and a half before the price starts to fall. And so what we're seeing is something called divergence. This is very good when you see divergence with this here, is that the MACD is either declining or increasing, but moving in the opposite direction of the price action. Price action made no new highs here, pretty much stayed the same, but yet MACD was falling the entire time, kind of predicting the move for us here. Now, a couple of things we want to note about using the MACD is that the three tips or the three recommendations that I have for having a bullish or bearish signal is that we want the crossover first. We also want some sort of divergence, that's number 2, and then also the crossing over of the zero line is usually number 3. But I don't necessarily use this to trigger my signal. I usually want the first two, but when we have that and you couple all three of those together, that usually means we're in a very bearish situation. Now let's talk about another example here. So we talked about a strong trend. When you see these kind of moves, it generally means a continuation. It's exactly what's happening. This is continuing on for quite a long time here. This is a daily trend, daily chart, and this is the dollar yen. So you're talking, a couple months here actually. This is about 3.5 months. MACD wasn't gaining that much. It wasn't gaining at the same angle, suggesting that, eventually this thing may fall. And it does. It starts to fall before the pair starts to fall, suggesting that divergence there. But the better signal here is this one here, where we have the good divergence in the MACD, and we have this kind of double peak here. So we have the double peak in the price action and the double peak in momentum with the crossover here and over the zero line. You really have all things in play to really give you a good sell signal on this one before the major drop. Now, some further tips for using the MACD. The most common crossovers you're going to see are the bullish ones. Bullish moves generally take a longer period of time than bearish moves do, and that's because when people are afraid that something's going to happen to their money, they have no hesitation pulling money out. Therefore, currency pairs, as well as equities, as well as commodities and futures, tend to fall faster than they do rise. It takes time and confidence to really want to invest in something and put your money continually into it. But there's no hesitation if you're worried your money is going to be in trouble. There's no hesitation on the buyer or seller to take that money out there. So the bullish crossovers are the most common ones seen, but they're also the least reliable. The other thing is this histogram here, which is really measuring the rate of change between these two lines here. This is a very popular part of the MACD. It was developed a little bit later by a man named Thomas Asprey. And the main thing you're looking for is sharp moves in the histogram to support the direction of the move and the strength. So in this case here, we see the falling on the MACD here, we notice how the histogram is increasing, suggesting that the rate of change between these two, aka the momentum, is increasing. This one too here is also really good. It flips to zero, it flips below this zero line here, and it gets pretty thick pretty fast. This is a very big change here in the histogram, suggesting that we're about to enter a very bearish move. So generally you want to look for those moves to support the particular direction that you're looking to trade. The other thing is when you look for peaks and troughs in the MACD, that's where you want to find your divergence. So when you kind of see these nice little peaks, that's where you're measuring the divergence basically. You don't want to measure divergence by trying to see it as it's in mid-move. You really want to see where does it lay its highs and its lows. Once it has two or more peaks, then you can use those to gauge the kind of divergence with the pair, as in this two kind of peaks here. And that's pretty much it. The larger the divergence, the greater or more significant the move will likely be. And so that's often what you're looking for when predicting these reversals or changes in swings. That pretty much sums it up. So to go over the finer points here, it's best when you have all three of the MACD signals in play. In particular, you have the crossover, you have the divergence, and the center line move. Again, the center line is not important. The first two are the most important, but it adds to the signal. To remind you also, the MACD is incorporating momentum. It's a great trend following indicator, and it's using moving averages to do that. And it's also great for discovering trend reversals, particularly via that divergence. It's good on medium to large or swing trading pairs. It's not good on pairs that oscillate in ranges that really won't give you that much information because it's using moving averages, which are generally ineffective in ranges. And the other thing is it's better on 2-hour, 4-hour, daily, weekly, or monthly charts. On the intraday time frames, the moves are too fast for the lagging indicators in there to really catch up. It's also not good for predicting tops and bottoms per se. It doesn't necessarily tell you where they are. And because of that, it has no upper limit in terms of measurement. That means the MACD line can continue as high as it wants to go. And so because it doesn't have a set boundary, you don't want to necessarily look at the extremes to really gauge whether you're hitting an extreme in price action or not. To summarize our services here, just to let you know, we do have some services to help you with your foreign exchange trading. First of all, we specialize in private education and mentoring. If you want to accelerate your learning curve, this is a fantastic way to do that. We also, if you don't want to do the guesswork and you just want to have trade signals generated easily for you, then I'd recommend the 2S Sniper system. We launched it in the beginning of 2008. It's had an amazingly profitable track record, which you can see on our website. And also, if you're looking for trade signals or live market analysis, we do 2 shows a week, and you're also welcome to check that out. So if you need information on that, visit our website, www.2ndskies.com, or email us directly, info@2ndskies.com. Good hunting, everyone.